Started the Okay, so I'm assuming you guys are already going through the modules on an active basis, and you should have completed most of the modules as of now, if I'm not wrong. But anyways, if you haven't, again, I would just suggest everyone to continue going through the modules because the certification is also based upon module completion. So apart from attending the live lectures, the weightage is also assigned towards the completion of the modules as well. And we have been discussing about different things in the previous sessions. We have been talking about markets. We have been talking about valuations, right? We also have been talking about financial modeling. So I was being requested to specifically discuss the financial modeling in the live session. So I'm just sharing my screen. Just let me know if my screen is visible to all. And this template is being shared with everyone already. If you don't have the session, don't have this template, I'll just reshare this template again on the group, right? So it is a core full-fledged financial modeling exercise, a full-fledged financial modeling template, right? And I'll be discussing a few of the most important points, a few of the points in this session if something is left in the next session, and the further subsequent sessions also regarding financial modeling and valuations, and a few of the premises that you guys need to keep in mind whenever you are doing financial modeling, right? So we have been talking about the various assumptions that we tend to utilize in the creation of the financial modeling exercise or whenever we are trying to forecast the company's futures and financials, right? We also talked about the different assumptions to forecast revenues, right? And that was again a live session. We also talked about the depreciation and the amortization schedules. We also talked about the working capital schedule. And how to implement all these things in the financial modeling exercise is something that we need to understand. So see, as you all know that what exactly is a financial model, right? It's basically trying to forecast the future financials of the company based upon the past financials. It can be the balance sheet, profit and loss statement, cash flow statement, everything we try to forecast for a future time period. And based upon certain calculations and parameters, we tend to ascertain the intrinsic value of a share or the fair value of the share. And then we try to compare the intrinsic value of the share or the fair value of the share with the current market price, right? And try to ascertain whether our share is undervalued, overvalued, and all these kinds of assumptions we tend to make, right? So I would just request, guys, if it's possible for you to switch on your cameras. That shall be really encouraging for me too. If it's possible from your side, then like well and good. There's no compulsion or no hard and fast rule for the guys to like switch on the cameras. But if possible, then please do it. So, see, like whenever we are preparing a financial model, the one thing we need to understand is whatever kind of future forecast we are doing for revenues or any of the line item in the financial modeling, it is not always based upon the past performance data as well, right? See, the simplest thing as we have learned about or like as we talk about in the market also, we have a previous trend of revenue or expenses, and again on the basis of that we are trying to forecast the future revenue or the expenses. Maybe we're trying to take the average number, right, out of the previous data and then applying that percentage number to increase the subsequent revenues in future, right? Like maybe we are doing that. But there can be some instances, there can be some possibilities in which you need not completely rely upon the past data or the past performance, right? It is good to understand the current data. And what do I mean by the current data is try to read the management commentary, try attending the conference calls if you have the access for. Because even if you don't have the access for the conference call, you get those meeting notes and conference meeting notes. And in all those things, you tend to get about the future revenue forecast projections for the company. The management of the company tend to come on different news platforms like CNBC, Z Business, NDTV, ET, Bloomberg TV. They come and talk about that they are projecting the revenue growth by a higher single digit, a lower single digit. They talk about the cyclicity of their companies, what basic parameters, or what macro indicators or macro environmental changes are impacting their revenues, right? By what percentage the revenues might grow or fall in future. So all those things will also give you a clear indicator, a much better indicator than just trying to focus upon the past performance, because past performance is all historical, Past performance doesn't always indicate the future, right? It might indicate in most of the scenarios, but it might not always indicate. And that is why even if you read the management commentary, that's much more realistic and that's much more forward-looking and futuristic. So for example, if a company has been like growing revenues by like 50%, 60%, like over the past 3, 4 years, right? And we want to project the future revenues of the company. So what exactly we shall be doing? Like we shall be taking the average growth rate of the previous revenues that might come out to be like 30, 40%, like somewhere in between. And then we might project the future revenues based upon that 30, 40% rate. But it can be a scenario that in the current year, when we are preparing the financial model and we're trying to forecast the future revenues of the company, the management might come on a news platform, the financial news platform, or like it might come through the conference calls, right? Or like might be some different routes in the online social media platform. And they might say that we agree the company's revenue grew by like 40, 50% in the previous year. But we believe in the future year, like due to this cyclical reason, or like due to this geopolitical tension, or like war conditions, or like due to some commodity price issue, we believe that the revenue of the company will just grow by 7 to 8% in the next 3, 4 years. So if the management itself is saying that we expect the company's revenue to grow by 7 to 8% in the next 3, 4 years, then there is no logic to take that 30, 40% ka number. Because management is somebody who knows the corporate very well. They know the corporate much well than the analysts who are researching upon the company. They know the corporate much well than the equity research analyst, your valuation specialist, financial modeling people, you and me. It's their company they know, and they have given that certain number of like 7 to 8%. And they have given that number, that 7 to 8% based upon their study, right? It is not just that they're giving some numbers randomly. They could have given a 30, 40 number percent also, right? If they want to, like if they wanted to show some false revenues or like false financial positions, right? They like could have said like 30, 40% we still believe, right? But being like realistic, they have like given a number of around 7 to 8% for the next 3, 4 years. Then there is no chance for you to use the previous historical numbers of 30, 40%. Use 7 to 8% for the next 3, 4 years, 5 years, and increase the revenue for the company, and that shall be the most realistic number. And that is why I always say to people that whenever you're preparing a financial model, do not always rely upon the past performance only. Do not always rely upon the historical data only. Also focus upon the present data where the management is seeing, commentaries, conference calls, everything. Because that shall really help you out in forecasting a future financial model and forecasting the future data. Again, that will not be 100% accurate. No one can predict 100% with accuracy that this is the intrinsic value of the share, or this is the fair value of a share, or this will be the value of the share when we are discounting the future cash flows to the present value. No one can predict that because different people have different assumptions. Until the point of time you have a rational for the assumptions, be it for the growth rate, the cost of capital, everything, you are right. But till the point of time you don't have a rational for the assumptions, you are completely wrong, right? It is not that I am teaching you here as a faculty for like for the financial modeling, I might be 100% correct, right? Even you might have some different assumptions of creating the financial model. Your numbers might not match with mine. I might have a different rationale. You might have a different rationale, but you need to back up that rationale with different reasons. JP Morgan is having an intrinsic value of a company A as a different value. Morgan Stanley has a different value. Goldman Sachs has a different value, right? Some companies saying to buy that share, right? Some companies saying to sell off that share. Some companies posting a neutral target, buy or hold, right? So they have different assumptions based upon different numbers and valuation metrics. What to choose from is your call. But again, the thing is to have an assumption for each and everything. Also, the safest assumption which people tend to take is when they aren't sure, right, ki what to do and how to forecast the revenues of the company. Yeah, like, for example, if the revenues historically have been growing at a very haphazard rate, or I would say, an uneven rate, or there can be a scenario when the revenues are falling in the previous years, right? There might be some cyclical event, there might be some contagion events. So how to forecast the future revenues for that company? And even the management might also not be so much confident about the number. They might not be saying an appropriate number, be it like 7 to 8%, right? So there can be like two scenarios in such cases. So either they tend to say the revenue shall grow by a higher single digit number. They don't give you that number, it shall grow by 7 to 8% or like 12 to 13%. They simply say that it shall grow by a higher single digit number or a lower two digit number. So if it is saying a higher single digit number, a safer assumption you can take is increase the revenue by 8 to 9%. That's it. If they are saying a lower double digit number, you can increase the revenue by 10, 11%, right? Always taking the most safest assumption, most realistic assumption, not being like overestimating to take the numbers at 30, 40%, not being underestimated by taking the numbers at just like 1, 2%, right? So that is something that we can incorporate. And the safest thing is if you can't even judge the management commentary, like if the management is not giving any kind of revenue guidance, higher single digit, low single digit, a number or double digit or like whatsoever, it is simply good to increase the revenue by the growth rate of that industry. So for example, if you're trying to forecast the FMCG का कोई company like HUL का तुम financial model बना रहे हो, and hypothetically you don't have a growth number for that. Assume the company had been in um, declining revenues for past 3, 4, though the company has not been, but like just to give you an example. So like choosing any company from the fast moving consumer goods industry, company A per se, and the revenues had been declining and the company has not given any kind of number, be it in single digit or double digit for the future revenue forecast for the company, right? Simply take the industry growth rate. At whatever rate the fast moving consumer goods industry, the FMCG space is growing in year after year, take that average number and grow the revenues by that rate. There can also be a scenario that the growth rate of that industry might not be there. The industry itself might be declining, or there might be some years of decline, some years of fall, and you might not be able to ascertain a number by which you should grow the revenues. In that way, it is simply to increase the revenues by the GDP rate of the country. Because there is an underlying assumption in a break-even scenario, in a normal scenario, ignoring the fears of recession or a Goldilocks one, ignoring like both the upsides and downsides. In a neutral scenario, an industry growth rate will not cross the GDP growth rate of a country. An industry growth rate will not cross the GDP growth rate of a country. Safest assumption, कुछ भी available नहीं है, take the GDP growth rate of a country. You can take a past 4-year, 5-year average, or simply the current number by which the RBI forecast that our GDP will grow. So, like yesterday, we had some number of like 6.4, 6.5%, right? It came down from like 7.2%, but the realistic number is like 5.4%, like for the previous quarter, right? The RBI was expecting 7.2, 7.3%, but the realistic number came out to be 5.4. And as a result, the RBI ने अपना like forecasting assumption भी change कर दिया है. It has come down to 6.4% for the next year, like 6.4%, 6.5% for the next quarter or the next fiscal year FY25 or something, right? So either you can take that 5.4% का rate or like 6.4% का rate at which the RBI has forecasted, right? So that was something. Or so that is the most simplest way of taking that assumptions. I have one question, said why industry will not cross GDP? No, industry can definitely cross GDP. I'm saying in case of a neutral scenario, when you don't have like any of the numbers to forecast, right? कि company का revenue guidance नहीं, कुछ भी नहीं है, right? And even the industry is not growing at a very high number. Like sometimes the industry is growing up, then down, then up and down, and you don't have a specific number to grow the revenues for the company. So the safe and back-end assumption is कि take the GDP rate of a country, because in a consolidation phase, when the country is not performing well, as we had a stagnant economy for the Japanese economy, for example, for 30, 32 years, the economy was all stagnant, right? And it achieved all times high after like 32 years or so, right? So whenever we are in a phase of consolidation and a particular industry in that particular country is not performing well, it has a kind of a volatile performance. So exactly what do we do? We tend to take the GDP rate of that country because it's an always an underlying assumption in that particular scenarios that industry will grow at a GDP rate. जितनी growth rate से तुम्हारी economy बढ़ रही है, same rate से industry भी बढ़ेगी. But ideally, we should always prefer an industry or a sector or a theme that grows at a rate which is more than the GDP rate of a country. Also, in the current scenario, if we can find any sector, any theme, any industry whatsoever, which has a higher growth rate as compared to the GDP of the economy, it's good to add the stocks from that sector in your portfolio. That is one way in which the people try to look at from the portfolio management context also. which sectors, which themes, which industries or stocks to have in your portfolio. Only those whose growth rate, industry growth rate is much more than the GDP rate of a country. Because they're growing more than the economy, they have a huge potential to grow. Can reliable to take average for past historical data. For past historical data, most of the people are taking the average in the recent scenarios, right? Just taking that average number and trying to forecast. But the best way, the much more reliable way is the conference calls. Like when you go to like large investment banks, work in these corporates, they more rely upon the conference calls. They take the conference call numbers and they just try to forecast, or they try to sometimes they use regression, as we discussed like in one of the modules or so, when they're trying to compare prices and volumes. But in 90% of the cases, they are using the revenue guidance because they talk to the management, they go to the management offices, they talk with them. Like even if the management has not declared these numbers in a public forum, but they go in there, the analysts go in there, they talk with them, they have some internal reports, some internal kinds of researches, and they tend to use that number to forecast the future. But as of now, since you don't have access to internal information or you don't meet the management on daily basis, either take historical data or get the conference call number. That is the best way. Okay. I hope that answers the questions of Naveen and Devesh. And no worries, Neeraj. So the thing is, yeah. So that is the thing in terms of the growth rate, like which, like whenever you are confused for like which growth rate to use whenever we're trying to forecast the company's financials or whenever we're trying to forecast the company's future. So all these things are something which need to be kept, which should be at the top of your head. Up on the two bases, we're trying to create the financial modeling here. One is on the basis of free cash flow to firm, FCFF, and the other one is the free cash flow to equity, FCFE. Okay. So whenever we're talking about the free cash flow to firm, so ideally, the free cash flow to firm, you tend to take your EBIT, you adjust it with 1 minus tax, with the tax. You are adding back your depreciation and your amortization, and you are subtracting your CAPEX plus your changes in the working capital needs. The changes in the net working capital needs. Okay. So we have been like discussing about FCFF and FCFE via the modules also in previous live sessions too. But whenever we're talking about FCFE, right? In case of FCFE, you are starting with PAT, right? The whole formula that you tend to see, it tends to remain the same. Just at the end, you add the changes in net debt. Or that is a change, but the net debt. The whole formula is same. At the end, you just need to add the net debt. So net debt or changes in debt or change in net proceeds. So ideally, it is nothing but how much debt you have taken minus how much debt you have given. How much debt you have given minus how much debt you have taken. Right? The difference between the two. Right? So if you just try to understand FCFF, because in majority of the cases, you shall be preparing the model based on FCFF only. Free cash flow to firm. So ideally, we have this EBIT, earnings before interest and tax, adjusting it against the tax, adding back depreciation and the amortization, subtracting the capex plus changes in the net working capital. So what exactly is the free cash flow to the firm? So this free cash flow to firm is the total cash flow which is available to all the capital providers of the firm. Now, who are the capital providers of the firm? Of course, the equity holders and debt holders. So for example, if a company wants to raise money in the market, the company wants the money for expansion activities, for diversification activities, for some new projects, or the company wants to reduce its debt, or like there can be some multiple reasons, like not to reduce the debt per se, but mainly for expansion, diversification, the company wants money. The company has two routes. Either the company can raise debt, the company can issue some fixed income securities like bonds, debentures, some notes, People can buy those fixed income securities. The money will go to the company, and in return, the company shall promise them a specific coupon payment or interest payment. Or simply the company can take a loan from bank. So all those kind of people become the debt holders who are guaranteed a certain interest payment upon the loan which the company has taken. The second set of people are the equity holders who purchase a certain stake in the company, right? Who provide the money and in return they purchase a certain stake in the company. Those are the equity shareholders. So this free cash flow is to the firm, as the name suggests, free cash flow to firm. And firm comprises of both equity and debt. So it is a cash flow which is available to both equity holders as well as the debt holders. And that is why we have taken here EBIT, earnings before interest and tax. For interest and tax have not been paid yet. And EBIT is something which is being looked forward by the debt holders of a company. Whenever a debt holder wants to see that how strong the enterprise is, how strong a company is, whether the firm shall be able to pay me my interest payment or not, because debt holders are just bothered about the interest payment. उन्हें उसके अलावा कंपनी से कुछ फर्क नहीं है, चाहे कंपनी अच्छा परफॉर्म करे ना करे, they're not bothered. They just want their interest payment because they have given the loan at certain interest rate and they want the principal plus interest back at a particular point in time, or they want in terms of their monthly EMIs or like whatsoever it is. So EBIT is something which is looked by the debt holders because it completely states you that whether the firm shall be able to pay you the interest or not, because interest has not been paid yet. If the EBIT of the company is 100 crores, interest payment is 10 crores, debt holders are satisfied. कि चलो ठीक है भाई, कंपनी ने 100 करोड़ का प्रॉफिट बना लिया and the company shall be easily able to pay me 10 crores. But if EBIT has come out to be 5 crores and interest payment is 10 crores, debt holders like will be in struggle. Will be asking multiple questions to the company that will we get back our interest payment or not? What is the process? Restructuring, like moratorium, like whatsoever, like what to do in that case. Correct? Though the company can pay from cash flows and different things, that's a matter of like separate discussion. But EBIT is something out of which interest has not been paid and debt holders are looking at this number. And that is why EBIT is something which is available to both the debt holders and equity holders. And that is why the FCFF, we tend to use EBIT. But adding back depreciation and the amortization, as we know that whatsoever it is, subtracting capex and the changes in the net working capital. Then we have something called as FCFE, free cash flow available to equity holders. Now from here, we are starting with PAT. The interest has been paid off. So basically what is happening, as the name suggests, is the cash flow which is available to equity holders only. Because equity holders are something that are just bothered about once the interest has been paid off, right? Because equity holders don't want the interest. Debt holders want the interest. Equity holders just want the share capital appreciation or sometimes dividend, right? If that is there. So once the interest has been paid off, debt holders are out of the story, they are satisfied. And whatever is left is available for the equity shareholders only. That is why using PAT here, right? So FCFF is only available to the equity holders and FCFF to both the equity holders as well as the debt holders. So the major difference you need to know from a conceptual point of view that which cash flow is available to whom. That is something. And also here we need to understand that whenever we are forecasting the future cash flows of the firm on the basis of FCFF, जब भी हम FCFF use कर रहे हैं, right? We're always discounting this FCFF by the overall cost of capital or your WACC, right? Weighted average cost of capital or the overall cost of capital or simply the cost of capital, discount rate, jo bolo. And this discount rate or WACC, it encapsulates both your cost of equity and cost of debt. Why? The basic premise of valuation. If in the numerator you have an equity number, you need to have the same number in your denominator also. If in the numerator you have an enterprise value number, you need to have the same in your denominator too. FCFF is an enterprise number. It is taking into account both equity and debt. And that is why we have to discount it by both equity and debt only. right? So we are discounting this free cash flow to firm by your cost of capital, which encapsulates both your cost of debt and cost of equity. Cost of debt is nothing. It is simply the interest payment that you are paying on debt. If you've taken a loan, the interest rate that you have to pay is 8%. 8% is cost of debt, right? No rocket science. Cost of equity, we calculate that by using a specific model. I've talked about that in my modules, in my live sessions, also like CAPM model. हम उसके बारे में फिर से बात करेंगे. It is nothing but your expected return on equity. How much the equity shareholders are expecting upon their investments, not the actual return, expected return. Actual expected में difference होता है. ठीक है? Expected return है, and both we are trying to encapsulate by using a certain formula, and hereby we calculate the cost of capital. But whenever we are calculating the valuation of a firm by using FCFE, we discount it by cost of equity. It is being denoted by key subscript E, because FCFE is an equity multiple. It has to be discounted by an equity multiple only. Then you don't take cost of debt, right? Ignore cost of debt. Discounted by cost of equity, just the cost of equity ka number, nothing else to maintain that consistency. Because valuation ka basic principle is to maintain the consistency of multiples. Okay. So coming back to FCFF, the free cash flow to firm, once you discount this number by this cost of capital for multiple years and add everything, you tend to get the enterprise value, EV, enterprise value, right? Because free cash flow is available to the whole company. So discount कर रहे हो तुम cost of capital, so you'll be getting the enterprise value only for the company. From the enterprise value, you can reach back to equity. एक formula और लिख लो. The formula for the enterprise value is nothing but it's your equity plus debt, market value of equity plus market value of debt plus minority interest, and you subtract your cash out of all this. Cash and cash equivalents. And here we are taking market value of equity, not the book value of equity. And what's the difference between market value and book value? Market value is the current value of equity trading in the market. Book value is at the time you invested into that company, उस टाइम कितनी वैल्यू इक्विटी की चल रही थी. हाँ, हमको उससे कंसर्न नहीं है, हमें एज ऑफ टुडे जानना है. सेम फॉर मार्केट वैल्यू ऑफ डेट plus minority interest. Now, the people who are the minority interest, those are those guys who hold less than 20% stake in the company. Those guys are the minority interest as per CFA definition, right? Like sometimes people also tend to say कि 5% से जिनके पास कम holding है, like those are only the MIs, right? But the thing is, ideally, as per definition or as per CFA standards, if someone is holding less than 20% stake in a company, he is a minority shareholder. If someone is holding from 21% to 50%, 21% to 49%, or like 50% per se, right? He's an associate shareholding. Crossing 50% is a controlling shareholding because you have a controlling stake. If we have more than 51% holding in a company, right? So minority, associate holding, and controllership holding, which is more than 50%. So equity, market value of equity plus market value of debt plus market value of minority interest. You have the sum and subtract cash and cash equivalents from it. In cash equivalents, you have marketable securities, short-term treasury bills, short-term treasury notes, like overnight securities, liquid funds, that right in which the company has invested, because those are not cash, but they are like closer to cash. They can be liquidated and you can get your money in your account on a T+1 basis, right? Very short-term securities, like which can be sold off overnight, T-bills, 91-day maturity, like 81-day maturity, right? So like all these things. So when you're discounting the value, you get the enterprise value. From enterprise value, how to reach the equity value is just a basic maths formula. Just interchange the numbers. ये तुम्हारे पास सब कुछ है, तुम्हारे पास एंटरप्राइज वैल्यू है, डेट वैल्यू है, एमआई है, कैश इक्विवेलेंस है. कांट यू कैलकुलेट ई? सिंपली यू कैन डू दैट. ईवी माइनस डी minus MI plus cash and cash equivalents. You do that, you get the equity value of a company. Basic maths. And to reach, because ultimately you shall be calculating the intrinsic value of a share. And intrinsic value contains only equity and not debt. So तुम्हें जब EV calculate करोगे, you have to go back to equity then. And from EV, how shall we go back to equity? By using this formula. Because a major mistake which people tend to do is they think the value of the company is equity plus debt. They will just subtract the debt from enterprise value and get equity. And that is wrong. You have to adjust against minority interest. You have to add back cash and cash equivalents always. When nahi karoge, the valuation is completely wrong. And you get the equity value and you can divide it by the outstanding shares to get the price of the company. Correct? But whereas when you are calculating by using the FCFE, free cash flow to equity, you are dividing it by the cost of equity. So what you get here is the value of equity only. You do not get enterprise value here. Consistency. And simply you divide it by the outstanding shares to get the price of a share, intrinsic price of a share. So FCFF will always give you the enterprise value, and you'll have to adjust that enterprise value with the debt, with minority interest, cash and cash equivalents to get the equity value. But FCFE will always give you the value of equity. For what type of companies we use FCFE? For what we use FCFF? For majority of the companies we use FCFF, free cash flow to firm. For banking companies, we use FCFE, free cash flow to equity. Why do we use that? Again, I'll restate the reason for that too. For many companies, apart from the BFSI space or the banking space, right? Debt is not mandatory. Debt is not mandatory. They raise debt, every company raises debt, but debt is not mandatory. ऐसा नहीं है कि if a company is not raising debt, they can't function. They'll stop performing extremely well. They might become stagnant, but debt is not compulsory. They can raise equity. They can use their internal accruals, some retained earnings, some cash flows. Non-controlling interest. Here you mean non-controlling interest when you say minority interest. Correct. So non-controlling interest. See, non-controlling interest, it encapsulates both the minority interest as well as associate interest, ideally. Because less than 50% is non-controlling. Right? So less than 50% is NCI. NCI का further bifurcation is associate and minority. So minority is less than 20%, 20 to 50% is your associate. Okay. Ab, yeah. So for every company apart from banking, debt is not mandatory. They have the option to raise debt to expand their operations or diversify or to run some new projects. Whereas they can raise equity, they can use internal cash accruals, some retained earnings or like whatsoever they can do, but debt is not mandatory, right? But in case of banks, debt is mandatory. Debt is the raw material for banks because how the bank makes profit, taking loan and giving out loan. The interest on which the bank gives loan minus the interest on which the bank takes loan. The difference between the two is a spread. It's a margin for bank. It's a net interest margin for bank, NIM as we call them. Net interest margin, NIM. The rate at which the bank gives out loan minus the rate at which the bank takes loan. The difference between both the interest rates. So for example, if I have taken a loan, if I am a bank, I've taken a loan at 7% interest rate because banks have to take loans from like one another. But if I'm giving out loans to a customer, will I be giving out at 7%? No. At 6%? No. It should be more than 7% at least, right? To make a profit. I'll give out at 10%. The rate at which I've given out loan minus the rate at which I've taken loan, 3% is my spread or the net interest margin. So that is something on which the banks work. FCFF formula में ही we use EV. FCFF formula में when you're discounting the free cash flow to firm by the discount rate, right? You guys are calculating your enterprise value. Not to worry for that. Some things are very new for people, right? But it is just a basic intro I'm giving. Not even an intro, like somewhat more than intro. But in subsequent sessions, mein na, we'll be calculating all these things. In different tabs, dekh rahe ho? Like we have all these calculations. Okay? So all these things will be done. Here I'm just giving you a gist of it, right? Once you watch the first 4, 5, 6 modules, also like you'll be having a gist of it, right? And these were a few of the things like that were discussed previously, but not to worry for that. The recordings are there. Okay. And also like we'll be going forward also in like all these tabs, like in this session, in the subsequent sessions. Okay. I'll share this file once again. I've shared this file multiple times, but I'll share this after the session. ठीक है? After the session में share करा दूंगा. तो एक second. Yeah, I'll share this. I'll share this. No worries. हाँ. So debt is basically a raw material for banks. But for the other companies, debt is not a raw material. Banks have to compulsorily raise debt. And there is no point calculating FCFF for banks, right? It's much more essential to calculate FCFE, right? Because basically debt is not a source of finance for banks. It's a raw material for banks, operating for banks. That is why we tend to use FCFE in case of banks, right? Cost of debt का specific formula नहीं है. It is just like whatever interest rate you are getting loan at. So that becomes your cost of debt, right? It can also be done if you want a specific formula. It is nothing but your interest by the face value of debt. If you tend to see like you tend to get a percentage number ideally, right? तुम कितना interest pay कर रहे हो annually, and if you divide it by your debt amount, you get the percentage rate of interest. So interest by net proceeds of debt maybe. Okay. So debt is a raw material for banks. The banks cannot function without debt. So for banks, NBFCs, I really tend to use FCFE. Like even for the insurance companies also, it is much more preferred to use FCFE, right? Because they're also taking debt directly, indirectly, right? They're using your premiums, then they are like investing that premium in the market to get the return, right? So it's an indirect form of debt. Though we'll be talking about the valuations of insurance companies, banking separately. There has been like modules being uploaded on the website too for all these stuff. But that is a major basic premise you need to know. Any questions, anybody till this point of time? Yeah, Siddharth, tell me.
Hello, sir. I just had a doubt. I had read in one forum, actually, it was couple of these investment banking forums. Another way which they calculate FCFF is by after calculating your EBIT one minus tax, which is your NOPAT. After the NOPAT, they subtract the NOPAT from the reinvestment rate. The reinvestment rate they have calculated using their same thing, the net capex and then working capital and all of that. So that is how they've arrived at FCFF. Is that also a valid way of calculating FCFF?
Yeah, that can be a valid way because they're trying to calculate that capex ka number, right? But right by using the reinvestment.
Yeah, they have calculated the reinvestment rate using the capex and everything, like how much the business is plowing back into its own, growth. And they are saying, especially for growth based companies, this is also a good way of calculating FCFF. So I just wanted to know what your thoughts on it.
I think you can use that. There shouldn't be any trouble because sometimes क्या होता है ना, this capex का number, like when they're calculating, they don't exactly use this capex. What they do, they instead of this, they tend to use a reinvestment rate. Now the reinvestment rate can be calculated differently by different analysts, right? Sometimes they tend to use a reinvestment rate as your depreciation plus change in net working capital divided by your EBIT into 1 minus tax. I've talked about these different methods of growth, capex, like reinvestment, like in one of my modules. But like, what do they do instead of capex? They tend to take a reinvestment rate that calculates your capex indirectly or directly. Because sometimes you don't have a capex for a company. How do we certain the capex? It might be a new company. A new company is obviously a high growth company, right? So that, as you like told me also, Abhi. So basically, they tend to use certain things. Either they use a reinvestment rate. If they get the capex, they use that, or simply they use the depreciation plus net changes in the working capital divided by your EBIT into 1 minus tax. Sometimes they tend to adjust it with no pat. So there can be multiple ways. Like different people are using multiple ways for valuations. Okay, Siddharth. I think that answers your concern.
Yes, sir. My doubt is cleared. And what they're doing is, once they get the median reinvestment rate, they are to calculate the the future forecast of the FCFF in the DCF model. They are saying that, let's say right now the company's reinvestment rate is 45%. Now, in that sector, in the terminal period, usually that industry will have, let's say, 65%. So
Mhm.
in the course of its forecast period, it will achieve 65% reinvestment rate as a bulk they calculated.
See, different people are having like different assumptions ideally. Okay. अब यहाँ पे like if I talk about my personal experience that investment banks like we aren't using like this approach, right? To either
Okay.
calculate the reinvestment or capex. Correct. But till the point of time the people have a rationale for this, they are right. Correct.
Okay.
I'm not saying they're wrong, but if they have a good rationale for this, right? Why this 45%, 65% of the terminal value, and they can explain this like with full facts and logic, right? They are right, right?
Okay.
So financial modeling is something that you get to learn from different experiences, like different sets of people, and then you make your own decision that which ideology or which method of forecasting you need to utilize. Okay.
Okay. Okay. Okay.
Okay. So this is one thing. The additions of right of use of assets or additions or intangible assets as capex. Right of use of assets, it won't be considered into capex ideally. It's more of towards the leasing side. You already have the asset into place. You aren't purchasing any asset, you are just using it for a specific time period. Or intangible assets as capex, if some new intangible assets have been purchased, right? So the R&D, the research and development expenditure, it's being categorized as your expenditure or capex and not as expense because that will give you return for a future lifetime, right? Expense is short term, expenditure is long term, and capex is linked to long term. Correct. So in terms of intangible acquisition in case of IT, देखो अब IT कंपनीज का कैपेक्स क्या होता है? It's intangible acquisitions, patents, copyrights, technologies, right? So it's a capex for them. So for those companies, intangible acquisition can be taken as capex. एक क्वेश्चन ऊपर था कि why do we subtract capex? The reason for subtracting capex is because whatever the company is, see, like whenever the company is growing or not growing, like whatsoever the condition is, capex is a very important ingredient which justifies the future operations of the company. अगर company capex कर रही है, it means the company has the growth projection, the company wants to grow in future. Right? Because if you talk about the basic accounting principle, right, the going concern principle in accounting, right, it says the business shall continue for a foreseeable future and there is no intention to close its operations, right? Because a business is meant for the profitability and shareholders' wealth, and the business shall grow for a foreseeable future. And to grow for a foreseeable future, the company has to undertake capex. The company has to undergo the capital expenditure, and that needs to be adjusted to get the exact free cash flow to firm. कि ये सब खर्चे करने के बाद कंपनी के पास कितना पैसा बचा है, राइट? बिकॉज कैपेक्स इज अ मेजर एक्सपेंडिचर फॉर द कंपनी. अगर हम उसी को एडजस्ट नहीं करेंगे, इफ यू वोंट बी एडजस्टिंग दैट कैपेक्स, देन एफ सी एफ एफ वुड जस्ट बी अ फ्लॉ. राइट? कैपेक्स इज द मेजर एक्सपेंडिचर फॉर द कंपनी. कंपनी का सबसे बड़ा खर्चा है कैपेक्स. एंड ओनली फॉर कैपेक्स एंड व्हाई द कंपनी इज टेकिंग डेट और इशूइंग इक्विटी, राइट, टू सस्टेन द कैपेक्स. करेक्ट. अगर कंपनी के पास पैसा होता, राइट, देन वो लाइक इक्विटी एंड डेट क्यों रेज करती? बिकॉज कैपेक्स इज द ह्यूज मेजर चंक. thousands and thousands of crores में like the people are doing capex, right? You take the government expenditure, right, like 11 lakh crores on capex. अब कम होगा like 8.5 lakh crores for this year, but 8.5 lakh crores is a very great number, right? And again, the government is funding that through debt also. The company issues debts, T-bills, T-bonds, and treasury bills, right? The company, the government pays interest on that. Taxes से लेते हैं, right? Taxes like another way. So that is the thing. So this is about your, and do we have to subtract lease liabilities in order to calculate equity value? lease liabilities in order to calculate equity value. See, there are two things. One is your lease liability, and the other is your R&D expenditure, right? The thing is, you tend to capitalize those things. A portion goes towards expenditure, a portion goes towards expense, right? So lease and R&D are two separate topics which are super advanced and which are left for some other part of discussion. But just to give you a very brief, like once we go future, like once we go ahead in financial modeling, I'll be talking about two things. One is your lease liabilities, and second one is your research and development expenditure. Because for both of these things, a certain portion goes towards your P&L and a certain portion is adjusted in your enterprise value for both your lease liabilities as well as the research and development expenditure. To tell you in very brief, whatever lease expenses the company is incurring, whatever lease expenses the company is incurring, kharche, it's an expense for the company. Monthly rental, saal ka rental, it goes in your P&L, right? But you also tend to calculate the present value of lease commitments. If you have idea about that, Sabri, it's an advanced topic. That's a matter of like separate discussion. जब basic intermediate से clear हो जाएगा, you tend to calculate the present value of the lease commitments, right? Because जितना जितना lease commitments you are doing, right? Because nowadays, as per IFRS, you just have a financial lease. Before to that, you had a bifurcation between the operating lease and a financial lease. Now that bifurcation has gone. Now everything is being calculated as a financial lease. Everything is regarded as a financial lease. There is no difference between operating lease and a financial lease. Naveen, not to worry for that. And that's why, like I was just saying, it's a complex topic. It's a matter of subsequent discussion. We'll be discussing that in detail. Okay, so not to worry for that. Because I knew that if I touch base this thing, that there can be thousands of questions. So I'm just covering it just for in an overview way, right? Because since every lease commitment you are paying is getting capitalized because it's considered as financial lease, because financial lease comes in your balance sheet, operating lease goes in P&L. But since operating lease has been discarded away, there is no regulation in India that categorizes something as operating lease. Short term, long term, everything is a financial lease that goes in balance sheet. So tend to calculate the present value of the future lease commitments as you do it for the cash flows. Present value of cash flow निकालते हो. Similarly, present value of the future lease commitments, and that get added to your enterprise value. And the lease expense for that year goes to your P&L. Same for the R&D. Now, the research and development is an expenditure, it's not an expense. And why it's not an expense? Because you tend to, because the company tends to get benefit out of that expenditure for years and years. It's not a very short term nature कि आज करा and कल benefit खत्म हो गया, या आज करा and साल के end में benefit खत्म हो गया, नहीं. So again, you tend to charge amortization upon the research and development expenditure because that is intangible. Amortized portion goes in your P&L, and the unamortized portion, which is not being amortized, it goes in your, it gets added to your enterprise value. That will do separately. Okay, not to worry for that. So then how to forecast lease liability, especially for retail companies, as the lease liability is very heavy for such companies. You ideally, for retail companies may, again FCFF is being done in a same way. The retail companies ka lease liability, you tend to get already in the annual report. In the annual report, once you go to the notes to account in the lease section, you get how much lease liability the company is paying every year. This year, next year, third year, fourth year, fifth year. All the lease liabilities or lease commitments are mentioned here. You need not calculate that, and simply discounting those lease liabilities by a discount rate, and you get the present value of lease commitments, right? And you add it back to the enterprise value. Okay. So not to worry for that. सेपरेटली एक सेशन में वो हम करेंगे. एंड इसके ऊपर एक मॉड्यूल भी है शायद, लाइक विच इज देयर ऑन द वेबसाइट इटसेल्फ, बट इफ नॉट विल डू इट इन द क्लास आल्सो. ठीक है, सो नॉट टू गेट कंफ्यूज फॉर दैट. एनी क्वेश्चंस एनीबॉडी एल्स अपार्ट फ्रॉम लीज पेमेंट्स एंड आरएनडी? लीज पेमेंट्स एंड आरएनडी का मैंने ओवरव्यू दे दिया है. Some people might understand it who have been watching the modules and attending live lectures or have a basic understanding, right? But it's a good point being touched. Maybe in next session, yeah, next to next session, like we'll be doing that. Lease and R&D ka. I'll be sharing you a few of my own personal notes also. Because like when I used to create financial modeling now, like in my initial days, like when I was a student, when I learned financial modeling, I used to have these notes I manually did on my booklet, right? And like even that booklet is saved with me, formula wise, and like amortized portion of R&D, like can amortize the portion of R&D, adding it to the enterprise value. Some portion is going towards P&L. All these kinds of charts and all I made. If I'm able to find that, I'll share those like pictorial notes also with you, and that should really help you out. Okay, that is one thing. Any questions as of now? वो बहुत अच्छे notes हैं. I was able to find them maybe 5 or 6 months back. I need to see like where they are. I can just share the image of that on the group. Oh, sir, all clear. Okay. Then see how to calculate the return on market. See here what we have to do, the return on market, beta, all these things are something we need to know. How to calculate the return on market? How much return the market has given you over a 5 year time period or a 10 year time period, simply by using the CAGR formula. So I just downloaded this data from the Bombay Stock Exchange, right? From the NSE or BSC. NSE का data like you'll get on the NSE, BSC on the Bombay Stock Exchange, right? End value is 1469. So like for whatever time period. So यहाँ पे the ending time period is 2021, 14691, right? 14691. And here you go above the starting value is 5835. Time period is 10 years. I've simply used the CAGR ka formula. You have the final value divided by the beginning value to the power of 1 by a time period, right? 1 by a time period. That's what 10 years minus 1. Simple formula for CAGR. And that gave me the market return. That shall be used in the CAPM model. I'll talk about that. Simply, I've calculated the market return. CAGR formula, final value after 10 years, divided by the initial value to the power of 1 by time period minus 1. And you can simply get this data from the Bombay Stock Exchange. XIRR function is much to calculate the CAGR. The XIRR is much more beneficial in terms of if you want to calculate a portfolio ka return where you are doing your SIP, right? For a one-time payment or a one-time lump sum amount, or if you want to compare just two values, starting value and ending value, CAGR is fine, right? XIR is something which is much more beneficial in case of when you're doing some monthly payments, right? Some monthly SIPs. And you want to take that into account because you have dates, you have cash flow payments and stuff. For that, you can use your XIRR. Okay. Mm, if I just go in here and Bombay Stock Exchange पे I go. In the Bombay Stock Exchange, uh, screen share is pause ना. रुको, share करता हूँ. See, go here on the Bombay Stock Exchange. Go to markets. Go to equity section. Simply if you go to like indices also. In indices, you have this historical indices data. Going to historical indices data, again going to indices historical prices. You can select the index like whatever index you want. daily return, monthly return, yearly return, and selected time period. So for example, if I want, मैं तो randomly कर रहा हूँ, time period from 1st October 2024 to 7th, and I press submit, I get the same format, open, high, low, close, जो वहाँ पे we have in Excel. And I can just download it from here. And all these numbers are here. So open का starting का and close का last I can just take in and calculate my CAGR. Again, how to extract data again has been discussed in the modules also, so not to worry for that. फिर CAGR calculate हो गया. Now see, if we talk about beta, right? So what exactly is a beta? Beta is nothing but beta is a measure of systematic risk or the non-diversifiable risk. Just always remember beta is a measure of systematic risk or non-diversifiable risk, the risk which cannot be diversified. So ideally, in finance, you have two types of risk. One is pure systematic risk, and the other one is your unsystematic risk or non-systematic risk. Systematic risk is also called as your non-diversifiable risk, the proxy for which is beta. Or unsystematic risk is also called as your diversifiable risk. So diversifiable risk is something that can be diversified away by creating a portfolio. So once you have a portfolio having different stocks from different sectors, you can diversify that risk. But because if one sector is not doing well, the other sector will really outperform. But systematic risk is something that you even cannot diversify by creating a portfolio because that is linked to market events, inflation, interest rate, geopolitical tensions, contagion events, black swan events, tsunami, XYZ stuff. Because no fund manager can predict these geopolitical tensions, the kind of Russia-Ukraine war, Iran-Iran war, like all these things, no financial analyst or equity research expert can predict that. When you create a portfolio, you have completely eliminated the unsystematic risk or the diversifiable risk. The unsystematic risk is also called as a diversifiable risk. It is zero for a portfolio because you've already diversified that risk by creating a portfolio. But a portfolio will always have a systematic risk. A portfolio will always have a systematic risk. The systematic risk will always be there in the portfolio because you cannot diversify that. It's based upon market movements, market dynamics, everything, right? So that is something. So a systematic risk is being connoted or denoted by your beta. Beta is a measure of systematic risk. And systematic risk is always being calculated against market. Against market. You cannot have the value of beta in isolation. If you want to calculate the beta of a stock, it cannot be in isolation. You have to regress it or you have to compare it or you have to calculate it against the market. Right? So basically what happens, your beta can be more than 1. It can be equal to 1 or it can be less than 1. If the beta is more than 1, it's an aggressive stock. Right? If it's 1.5, if it's 1.1, it means if the Nifty or the Sensex rises by 10%, the stock rises by 11% or 15%. That's good, but in vice versa, it's a problem. If the Nifty falls by 1%, stock will fall by 15% or 11%. That basically happens in case of aggressive companies, growth stocks, right? Like IT, your tech companies, your real estate, cyclical industries, heavy industries, cement, manufacturing. Whereas if you have a beta of less than 1, those are defensive industries like FMCG, it can be pharma, right? So agar beta 0.8 hai, if the market is rising by 1%, right, or 10%, the stock will just rise by 8%. Might not be good in that scenario. But if market falls by 10%, stock will just fall by 8% because the beta is less than 1. And is equal to 1 kya hai? Whenever someone asks you that what's the beta of Nifty or Sensex, the beta of Nifty and Sensex is always 1. Because Sensex को Sensex के साथ कंपेयर करके कुछ होना नहीं है. निफ्टी को निफ्टी के साथ कंपैरिजन कुछ तुक नहीं है. करेक्ट? Always compare your stock with the market performance. HUL against Nifty का performance. IDFC against Nifty का performance. HDFC against the Nifty का performance. You don't compare Nifty का performance with Nifty का performance. Right? तो दैट इज बाय वही चीज करी है। सेम वे में मैंने यहाँ पे निफ्टी का रिटर्न ले लिया है। आई शेयर दिस फाइल विद यू वंस अगेन, राइट? आई हैव कैलकुलेटेड द डेली रिटर्न सिंपली क्लोजिंग वैल्यू माइनस द बिगनिंग वैल्यू डिवाइडेड बाय द बिगनिंग वैल्यू, परसेंटेज चेंज फॉर्मूला, सिंपल फॉर एवरी डे आई हैव डन। सेम आई हैव डन फॉर माय हाइपोथेटिकल कंपनी। ठीक है। अब द थिंग इज, इन दिस केस द करंट डेट टू इक्विटी रेशियो ऑफ द कंपनी 10%। इट्स अ हाइपोथेटिकल नंबर, डोंट आस्क मी कि 10% आपने कैसे कैलकुलेट करा है। वी आर एज्यूमिंग द करंट डेट टू इक्विटी रेशियो फॉर द कंपनी इज 10%, राइट? हाउ टू कैलकुलेट बीटा? नाउ बीटा is a leave. Now again in beta you have two types of beta. One is a levered beta and the other one is an unlevered beta. So as the name suggests, in case of levered beta, you have the impact of debt. It is levered. Debt is a part of that number. Is 0.60 में debt है. But when you talk about unlevered beta, it means debt impact has been ignored. It doesn't have debt. So यहाँ पे I've calculated a 5-year levered beta because my forecasted period is 5 years. How to calculate that? You have an inbuilt function in Excel called as a slope function that gives you the beta, the rate of change, the slope. So firstly you take the stock के returns, पूरा column select कर लिया, comma ये market के returns. And once I do that, I get my slope, my beta 0.60. It's less than 1. My company is a defensive company. Aggressive नहीं है, इसका beta less than 1 है. Right? Now, I read some management commentary. I read some conference calls. And the management is saying they're planning to make the debt to equity ratio from 10% to 4% in the next 5 years. तो बोल रहे हैं कि अगर डेट टू इक्विटी आज 10% है, इन द नेक्स्ट 5 years इट विल कम डाउन बाय 6%, एंड देर फोरकास्टिंग इट और ट्राइंग टू मेक इट 4% नाउ, राइट? सो if they're trying to forecast it as 4%, then why will I use the 10% debt to equity ratio in my forecast? It's a historical, it's a lagging debt to equity ratio. My financial modeling is all about forecasting the future. I need to forecast my future financials. Then what shall I do in that case? I will unlever my beta. I will remove the impact of debt from my beta. That is, मैं 10% 0.60 में से निकाल दूंगा. I'll remove this 10% from 0.60 and again include just 4% because my financial modeling is futuristic. I have no concern with my current debt to equity ratio. It's historical for me now. I want my new target debt to equity ratio, which will highlight my future financials. ठीक है? So how to unlever my beta? Simple formula for that. You have the levered beta divided by 1 plus debt to equity ratio into 1 minus WACC. How have we calculated WACC? That we learned in this tab. It's a formula. WACC is your weighted average cost of capital that we discussed. FCFF को हम जिससे डिस्काउंट कर रहे थे, ठीक है? सो और लीवर्ड बीटा डिवाइडेड बाय 1 प्लस डेट टू इक्विटी रेशियो इनटू 1 माइनस WACC. अब इसमें से अपना डेट हट गया है. इट इज अनलीवर्ड बीटा. इट डजंट हैव डेट इनटू इट. बट नाउ यू हैव टू रीलीवर दिस बीटा. हमने 10% निकाल दिए. वी रिमूव दिस 10% आउट ऑफ इट. नाउ वी हैव टू ऐड दिस 4% इनटू इट. वैसे वर्सा फॉर्मूला. ठीक है? क्या करा मैंने? माय अनलीवर्ड बीटा इनटू 1 प्लस टारगेट डेट टू इक्विटी रेशियो इनटू 1 माइनस WACC. I'll share this file with you. You guys can remember the formulas, right? Now I relever this beta. Now this levered beta 0.57 shall be used for further calculations, and that I'll tell you where, right? So the first thing is whatever is my historical debt to equity ratio, I need to ignore that. I need to remove that from my current beta. I need to unlever my beta and relever my beta once again to have that target debt to equity ratio. And that is why I'm saying reading, understanding management conference calls, commentaries is very important. I come to WACC here, right? How to calculate? See, a cost of debt is 8%. It's simply the rate of interest at which the company has taken loan. Okay, like no rocket science. Then you here have cost of equity is calculated by something which is called as your CAPM model. Capital Asset Pricing Model. CAPM model. Capital Asset Pricing Model. It says your cost of equity is equal to RF, the risk-free rate on government securities, plus beta into RM minus RF. The risk-free rate is a risk-free rate that you get on a treasury bond, a treasury security. You have different securities for different kind of maturities. So since we are forecasting the financial model for 5 years, take a 5-year treasury bond. So whatever interest rate you are getting on a 5-year treasury bond, take that. As of this case, on a 5-year treasury bond, I'm getting 6.71%. How to get this number? Simply type on Google the risk-free rate on a 5-year treasury bond. Or the second way is what? The second way is you go to Google. You have a site which is called as, go to ZCYC, Clearing Corporation of India. They also give you numbers. You go to the ZCYC, you go to the zero rates, and you get all these numbers here. For a zero, for a 2.5-year maturity, interest is 6.5 currently. For a 4.5, it is 6.57, and you can get the numbers for 5%, 10%. Or simply you can just type on Google कि भाई मुझे 5 ईयर का ट्रेजरी बॉन्ड यील्ड रेट चाहिए. You will simply get that. Plus, this is the beta that we have calculated previously, the levered beta. CAPM model always uses the levered beta into RM minus RF. RM is the return on market that we have calculated by CAGR. And again, it is the risk-free rate. And the difference between RM minus RF is called as your equity risk premium. It's called as your equity risk premium. And why do we call it as your equity risk premium? Because you are taking that additional risk over the risk-free rate and investing in the market. Because the risk-free rate is risk-free. It's giving you a very less rate of return, the basic principle of finance. Higher the risk, higher is the expected return, and lower the risk, lower is the expected return. In government securities, you are taking the least amount of risk. Hence, you get a lower return. And when you go to the Nifty 50, this RM is your index का return. किसी stock या portfolio की बात नहीं हो रही है. Index का return Nifty or Sensex. And when you are investing into a Nifty or Sensex, you get more return as compared to the risk-free rate because equities are risky. And you are taking that additional risk to go in market. So the difference between the market rate of return and the risk-free rate of return is your equity risk premium into beta plus your RF. And you get your cost of equity. So someone asks you in general that what exactly is the CAPM model? The CAPM model, it tries to establish a relationship between your cost of equity and your systematic risk, which is beta. It is trying to establish a relationship between your cost of equity and systematic risk. And here you get your cost of equity as well. तो वही यहाँ पे calculate हुआ है. We have the risk-free rate as 6.71% again taken from Google or the ZCYC website. Market rate of return, again calculated. Equity risk premium, it is nothing but it's a difference between what? Risk-free, the market rate of return minus the risk-free rate of return. Beta we have calculated. Cost of equity, CAPM model के फॉर्मूले में डाला, अपने पास आ गया. Cost of debt, debt is always calculated post-tax because debt always has the benefit of the tax deductibility of interest. ठीक है, तो इसमें से मैं टैक्स एडजस्ट कर दिया into 1 minus taxation because 25% is the standard tax rate for corporates, right? 8 into 1 minus taxation. And there we calculated the WACC. How to calculate WACC? The formula for WACC is very simple. It's your weight of debt into cost of debt plus weight of equity into cost of equity. How to calculate cost of debt and cost of equity, we know it. And this is a post-tax cost of debt. It's not 8.5%, it is 6% tax adjust करके. And how to calculate weight of debt? Simple. For example, if a capital structure has 100 crores, 60 is debt, 40 is equity. The weight of debt becomes 0.60 and equity becomes 0.40. Simple maths. And वही यहाँ पे करा है. If you see, weights 4% is debt. Our target debt to equity ratio was 4%. तो अगर 4% debt है, common sense, 96% is equity. Cost of equity is 6%. Cost of debt is 6%. Post tax, always post tax. Remember that equity is 8.4%. We calculated the WACC. Or simply we can use a sum product formula also. Sum product will automatically multiply the weight of debt into cost of debt and add the weight of equity into cost of equity directly. And you shall get WACC here as 8.30%. That's your weighted average cost of capital. And it is the rate at which you shall discount the future cash flows. That is something we need to understand. Cost of debt is the interest rate, right? Perfect. Yes. Any questions, anybody? Rest of the forecast we shall do in the next session, right? But any questions, anybody? I'm waiting for questions. Anybody, any questions? Equity, we are expecting the return after considering systematic risk. Yes, Naveen, you are right. Perfectly, you got the point. Any questions, anybody else? Okay. So I'll be uploading the recording also on the website. Also, guys can go through the modules and you can come back to me for any questions and doubts that you have. Take care. Yeah. I'll share on the group. I'll share on the group. Take care. Chalo then. Okay, guys, then feel free to ask me any questions. Let's get back in the subsequent session. Thank you so much. Thank you, guys.